Wouldn't it be great if your son or daughter could attend the college of their choice without any borrowing? They wouldn't have to borrow and you wouldn't. It would be great, but it doesn't happen very often. So let's take some time now and cover the 10 loan options that exist. 3 of these loans are a part of the financial aid cycle, and you've heard me talk about them. Loans like the 2 Stafford loans, the subsidized and the unsubsidized Stafford loan. Let's first talk about the subsidized Stafford loan. This loan is attractive for many reasons. If the EFC number is lower than the total cost of the college, you may see a subsidized federal Stafford loan in your award letter. It's a student loan, not a parent loan, written in the student's name. And while the student's in college, the federal government will pay the interest on that loan. That interest doesn't begin to accrue until 6 months after graduation. The repayment program is very flexible. It used to be that most students paid their Stafford loans off in a 10-year window. But now, with the new administration, there's even more flexibility on how a student would repay a Stafford loan. Remember, the subsidized federal Stafford loan has some maximums: $3,500 in freshman year, $4,500 in sophomore year, and $5,500 in each of junior and senior year. And then you have the unsubsidized federal Stafford loan, an opportunity to borrow an additional $2,000. But the key here is that the federal government does not pay the interest on the loan, but it is a student loan and not a parent loan. If I were to receive no subsidized Stafford, I could then get to the maximums using all unsubsidized. That would be $5,500 in freshman year, $6,500 in sophomore year, and $7,500 in each of junior and senior year. And then there's this other very attractive student loan program, the Perkins loan, federal money that goes directly to the colleges. These are tough to get, though, and there's only a limited amount of Perkins loan money available. What makes it attractive are the same reasons: student loan, not a parent loan, free interest while the student's in college, the federal government is paying the interest on the loan, and a flexible repayment program after graduation. The Perkins loan repayment doesn't begin until 9 months after graduation. But now let's assume that we have to go beyond any of those student loan options. Now we're in the parent loan options, and we might want to look at the equity of your home. Some families choose an entire refinance. They will refinance their mortgage, perhaps to a lower interest rate, allowing them to tap into the equity of their home as cash flow. Some will take a separate home equity loan, take a lump sum out, and use that as a fund to pay for college. And then, of course, there's the option that I really like, the line of credit. The line of credit simply is you establish the line of credit, it's provided to you by the lender, but you don't pay that back, and usually you're only paying interest only to the lender. You don't pay it back until you actually write the check to the college. And so you have these 3 possibilities emanating from the equity of your home, all of which can be tax deductible. The interest will be tax deductible on a tax return. Let's go after other loan options. Some of those loan options could come from your retirement plans. If you have a 401k or a 403b program, these programs typically allow you to borrow. Now here, you're borrowing against yourself, which means you are repaying yourself. You're repaying yourself in interest, but you are not repaying to an outside lender. There are some benefits there. Here's a point though. When you borrow money, be aware of the fact that if you're in the market and we have an uptick in the market, you will be pulling dollars out of the market. So borrowing against your retirement plan at work works great in a down cycle of the market. Other than that, what other types of loans could we get to if we didn't want to access the equity of our home and we didn't want to borrow against the retirement plan, or we didn't have that capacity? The federal government will allow parents to borrow in a program called the Parent Loan to Undergraduate Students. This is a parent loan that gets paid back right away, principal and interest. In other words, the repayment program begins as soon as the borrowing occurred. It's not deferred until after graduation, like the Stafford loans would be. In terms of the principal and interest, it indeed is a interest rate that varies. And so you want to be conscious of comparing interest rates from one loan option to another. Let's go to some other options. Now, some families, especially in the last 10 years, have exercised alternative student loans. This is a joint loan where the parent has to co-sign. So the student is doing the borrowing, but the student needs a co-signer. And so the parent develops this obligation down the road if the student defaults. Let me continue on, because if you're fortunate enough to be in a college that will allow you to borrow money from them, where the college acts as a bank, so to speak, and indeed creates a loan option. So let's review then the 10 loan options. You have the subsidized federal Stafford, the unsubsidized Stafford, the Perkins loan, student loans. You have 3 different ways that you can borrow against the equity of your home. You might be able to borrow as a 7th option against a retirement plan at work. Option 8, using the parent loan to undergraduate students. 9 is this combined alternative or supplemental student loan where the parent is a co-signer. And the last loan option is if you're fortunate enough to deal with a college that will create a loan themselves. These are the 10 loan options. I hope that you use these discreetly, but they may be important components of how you pay for college.